G'day, I'm Andrew Malcolm from iRefi Mortgages, and today we're talking about mortgage secrets. So if I was to say to you, you've got to choose between $1 million property or $100,000 of passive regular income annually for the rest of your life, what would you pick? For me, it's an easy decision. The $1 million property is a nice to have, but if somebody's going to give me 100 grand every year for the rest of my life, that's what I'm going to pick. And what I want you guys to understand is that using the mortgage secrets that we're going to be talking about today, that's exactly what you can create. Using investment properties and just learning a few tricks of the trade is going to help you build up your property portfolio and build up your passive income so that you can get more financially secure, you can get that financial freedom that you're after. So what I want you guys to understand from the mortgage secrets is what we're trying to do is put this regular passive income on autopilot. And so when I say, do you want your $1 million property or $100,000 regular income, you actually can have both. You can keep your family home, you can get the debt paid down over the same period of time, and you can get other people to pay off the mortgages for you on your investment properties. So what are you going to learn today from the mortgage secrets is you're going to learn how to pay your debts off faster, specifically your mortgages, and you're going to learn how to generate passive income through a property portfolio. And we're going to cover mortgage secrets that we've learned after reviewing thousands of mortgages, Kiwi mortgages, over the last couple of years. So if you're looking to spend more time with family, you're looking to go fishing, play golf more often, maybe you want to get back and help out the community through the church, or you want to spend more time doing charitable work, or you just want more time for yourself, passive income is going to be the way that you're able to do it. And if you want to not have to work for money, you're working for fun and because you want to, having that regular income from property is going to be the way that you can get there. So what you really need to know is what's your magic number. Are you looking to create an extra 10 grand or 30 grand or 50 grand or 100 grand a year? Because you really want to say, okay, I got 10 to 20 years to do this. I'm going to build up a property portfolio. I need to get some properties freehold or a low amount of debt on them. So at the end of every year or over the space of the year, I'm creating a surplus, a cash flow positive property portfolio. And once you know your number, let's say $100,000, you need to figure out how many properties it's going to take for you to build it up that you're going to get that income annually. And if you don't know what your number is, it's really hard to get to that goal, because you don't know if you're one investment property or 4 investment properties away from reaching your financial security. And if you've got 100 years to do it, it's really easy, but you might only have 5 or 10 or 20 years to do this. So it's important for us to put a line in the sand and say, hey, what's your number? Maybe it's $100,000, and we'll start with that number. And we want to build backwards from that of regular income. So who is this for? It's for mum and dad property owners, for mum and dad investors that are looking for a way to build up their financial security, get to financial freedom as soon as possible, and they're committed. You're committed to getting ahead, you're still deciding, you're still dealing with your bank, maybe you're dealing with a broker that you're not getting much advice from, maybe your broker, it's more of a transactional relationship and you feel like you're not getting the right advice from them, and so that's who we help. That's some of our clients, 1 or 2 properties, some of our clients 30 to 40 properties. We help these mum and dad property investors continually grow their property portfolio. And so what you might be in is a stage you can feel your equity building up, but you don't really feel like you're getting richer. You don't really feel like you're making progress towards your financial freedom at the pace that you want to. So those are the kinds of people we look to help. And I want to give you a quick case study. So my business partner Blandon, his parents, they owned a bunch of properties. And what they got to a stage was they were looking to take a little bit of time off work. They owned fish and chip shops. Business was going really well. They had a couple of investment properties, but they got to a point where they were getting a little bit scared of how much debt they had. So they took some advice from a real estate agent and they sold their properties, a couple of them. And they sold at a bad time. And this without them realizing at the time, has set them back to the tune of probably more than $500,000. They didn't get good advice at the time. They were unable to keep buying properties once they got back to work. The rules had changed. And so now, instead of having those investment properties over the last 10, 15 years building up capital gains and producing positive cash flow. They haven't had that. And so when you contrast that with another more clients of ours, a lovely Malaysian family, very modest incomes, what they've done over the last 20 years is they've patiently built up a property portfolio. Every few years they've just bought another property, refinance, buy another property, refinance, buy another property, and now what they've got is an enviable property portfolio that's very cash flow positive. They've never made more than 130 combined income annually, but what they've done is they've built up, millions of equity, and this property portfolio is producing them money every year, and it's pretty much on autopilot. And so very simple. It's very similar backgrounds, but it's the mindset. The mindset that debt is not a bad thing, as long as you've got a good plan in place, and as long as you're getting good advice along the way. And if we go back to that original statement about having $1 million of home equity or $100,000 of passive income, if somebody else is paying your debt for you, your tenants, then debt is actually a really good thing, especially if through appreciation your properties are getting capital gains every year, and there's a little bit of a surplus at the end of the year. There's also tax shields as well. The debt is not a bad thing. You just have to learn to understand it, and that the debt is your lever, using leverage to be able to get capital gains on a bigger number. So how do we know this? Well, iRefi has reviewed over 10,000 Kiwi mortgages in the last few years. We kind of know what we're talking about. We have deep dived into the mindset and the success of how property investors have operated over the last 30, 40 years. Some of our clients are in their 80s, huge portfolios. We've seen how the buy and hold strategies have worked, and we've also seen how property investors are able to create equity quickly through a various different strategies that we will talk about in the Mortgage Secrets program. So a couple of clients I want to touch on. Rod, lovely guy, business owner. He's got a couple of different businesses out west, and he has a property in Remuera. He had quite a bit of business debt, and he was getting a little bit worried about what was going on, and he was thinking that he would sell his Remuera property that he was renting out, pay down some of his debts, get a bit mortgage, clear the debt, mortgage free, and he can relax, and maybe he'll go buy another property after that. What we managed to uncover is that he was actually overpaying his interest expenses by more than 30 grand a year, and through a small restructure and making sure his accountant actually knew what he was doing, what we uncovered is his accountant was missing a few things, maybe just operating on a 2008 model instead of a 2018 model. Rod was able to refinance some of his debt, get back on top of things, and instead of selling this Remuera property that is getting massive capital gains every year, he was able to actually get into a position who'd buy another property. And so instead of renting his place to somebody else and then renting himself, he's able to keep that Remuera property and buy a new home, and he's much happier. He's paying 30 grand less a year in interest, and he feels much more comfortable with the advice that he's getting. Gary, he came to us thinking, hey, I'm going to sell my house and buy another house. I want to upgrade. And so we had a quick look at his business accounts. The bank had kind of said, hey, no, we think you should sell then buy. And we actually identified to him that keeping the current property he had was a really good idea, turn it into a rental, and he actually could go and buy the home he wanted without selling. And what this means is rental income, capital gains from two houses, and instead of just leapfrogging from one property to another, selling and then buying, he's able to build up his property portfolio. And because his business is doing well, this property, this rental property, his old family home, is actually cash flow positive. Like he's feeling much better about it. The bank had originally said no. We showed him a few options, and him and his wife are stoked with the outcome. Another client, I'm not going to mention their name, but out on the North Shore, they got 30 plus properties in their family's portfolio. Huge cash flow positive surplus at the end of the year, and their income from just salaried work was over $500,000 as well. They were trying to buy another property. They had obviously a lot of equity. I think they had about 4 or 5 mil of debt, and their property portfolio worth over 20 mil. And the bank was saying no. and the challenge was the bank was looking at their portfolio at commercial rates. They had a private banker helping them, and just the bank policy wasn't allowing them the options to buy property in the way they wanted to. So we came along and we pointed out a few areas where there was a lot of room for improvement. So we took a few properties out of their portfolio that were secured at the bank and got them pre-approvals at other banks. Obviously the banker wasn't so stoked about it and tried to pull them back into the fray. But what this client had saw is that there really was a tremendous amount of value having an outsider come in and make suggestions, and also to understand bank policies. And we were able to get them a couple extra properties without too much hassle, and now they're building their property portfolio at the same pace that they wanted to, rather than the bank dictating to them. Another client that we've recently helped, a real estate agent out on the shore, he found after a year and a half in the business, he was finding really awesome property deals, and he wanted to buy another property. He hadn't been in business for 2 years. The bank was saying, not a good idea, you need to wait another 6 months. After he'd applied to buy this property, bank had said no. We presented in their branch that week, and he gave us opportunity. We went back to that same bank. We showed projected accounts. We talked to the accountant, and that same bank said no 1 week, said yes this week. And it's just about how we presented the application to make it so that the real estate agent was, he deserved to be able to buy this property. His income was good, but the bank just didn't quite understand it without a little bit of help from guys like us. So there's a few quick examples of understanding mortgage secrets is going to allow you to continue to buy your property, reduce the amount of debt that interest that you're paying annually. And if you want to buy a property, even if you've got lots of equity, sometimes you need to reposition the application to make it so that it's much easier for the bank to say yes. So some of the challenges that the industry faces, us as mortgage advisors, is that people are quite loyal to their bank when they don't realize a bank isn't actually really that loyal to them. And if you're not getting cash back from your bank every few years, if you're not 100% certain that you're getting the lowest rates, and by the lowest rates, I mean, 4.09 is a very common rate at the moment. If you feel like you're going to push every time to get the lowest rates and you're still unsure, you're wasting your time. Mortgage advisors in New Zealand, for whatever reason, are able to get lower rates than quite a few clients. And it's a free service that we're offering. So instead of focusing on trying to negotiate with banks or bankers yourself, sometimes it's better to let a middleman come in and push the bank for the rates that you deserve, and to provide advice along the way. And that brings me to my next point, is bankers don't really give advice. They're not really allowed to. Not all of them understand property investing. And I tell you what, if the only way for you to get what you want is to walk out of your bank and go next door to the competitor bank, do you think that your banker is going to say, hey, I can't do this, but I know the competitor bank next door can do it? That's not going to happen. And what you need to understand is the bank lending policies are very different at all the different banks, and they change often. So unless you're working with a company or an advisor that understands the bank policy and that's dealing on a regular basis with all those changes, the odds are that you're going to miss out on a few times, especially when it's marginal. You don't want to go to buy an investment property. You need $900,000, and your bank's saying, well, you can only borrow $700,000, when in reality, you just need to get another bank involved that looks at your numbers slightly differently, and you can get that approval. And sometimes your bank's just not going to do the lowest rates. There's one bank in particular over the last 3 years that they've never ever been competitive on rates. One of the main banks, and it's one of New Zealand's favourite banks, and they never give the lowest rates. And if you're completely loyal, that relationship is costing you thousands of dollars a year. Would your friendship with your bank or your banker, would you pay thousands of dollars a year for that relationship? My guess is no. So you've got to get over this whole bank loyalty thing, and be loyal to yourself first, and use the banks for what they're there for. They are there to lend you money to help you expand your property portfolio, and you shouldn't be tied to them just because you opened a bank account with them 30 years ago. The color of the bank should be your only, measure of their worth. They're just money lenders, all right? Another thing that I want you guys to keep in mind is one of my clients who used to be a director of one of the big main banks, and when he left,